Welcome, everybody. Welcome to this edition of Ramblings of an Old Fart podcast. Hello, my name's Craig Warren. I'm 71 years old and been married almost 53 years. Father of 9 and grandpa to a bunch. I'm sort of retired. I retired to provide full-time care for my wife, who's had some pretty serious health issues. But lately I realized I needed something to do to keep my mind active, so why not a podcast? I mean, I have a lot of experience, and I definitely have a lot of opinions, so what more would I need? I should mention that I have never been a member of a political party, and I don't intend to do so. My podcasts do not come from a political place, just from a factual and common sense place. I've titled this podcast today, The Federal Reserve. Is it really federal? And this kind of came to be because I've heard so many news articles and so much going on between President Trump and Jerome Powell, the top dog at the Federal Reserve on their board of governors. And all of this stuff about, I don't know, some investigation into how much money they're spending, like $2.4 billion for renovation. President Trump and him have disagreed over the interest rates, those kind of things. So I thought, I should check into this and find out a little bit more about this Federal Reserve and how it works. I've thought over the years that I kind of knew, but I'm kind of finding out I didn't really know as much as I thought I did about it. So let's kind of take a look at it here. The Fed and the debt progression system, that's all tied to it. But here's the thing. The Federal Reserve is kind of like a two-headed monster. There's a public agency, right, in D.C., that's the Board of Governors. But they oversee 12 private regional banks owned by commercial member banks. See, the board is a federal government department with a twist. They don't get paid from the Treasury. They make their own money from U.S. bonds that they hold. And that's how they cover our deficit spending. If we don't sell enough Treasury bonds and Treasury notes to other people, big companies, big business, investment people, and foreign governments and things, then they buy enough those bonds to help so that we can meet our obligations. Or at least that's the theory, right? But I liken this, when I got looking at this, the closest thing I can do to describe how it works is more like a casino. Most people think the government has a budget. No, they don't. They have a no-limit credit card, if you will, or a checking account with overdraft protection. And so the Fed just increases the limit or covers the overdraft whenever they hit that level. In Vegas, the casino has what they call the house edge. It's typically about 5%. And then if you're caught counting cards or rigging the machine or something, you go to jail. But in D.C., the feds have put in a guaranteed 6% dividend for the Federal Reserve banks. If or when the primary dealers get stuck with bad debt, the Fed just changes the rules of the game and makes the debt legal tender again. They just, with a couple of keystrokes, just turn that into digital money. The scary part that I see here recently, in 2026, other countries are starting to walk away from the table. They're taking their winnings in gold and heading for the exit, leaving the U.S. and its citizens holding a pile of chips that are losing value by the hour. Commercial banks are required, if they're a nationwide commercial bank, they are required to buy stock in the Federal Reserve, in their local branch. But they get a statutory guaranteed 6% dividend, and then a seat at the table, right? I kind of look at this as the fox guarding the hen house. I don't know. I'm not sure how else to look at it. But if the bank is nationally chartered, like I said, J.P. Morgan, Chase, Citibank, Wells Fargo, it's required by law to be a member of this Federal Reserve and to buy in by purchasing stock in its regional federal bank. State chartered banks can choose to join if they meet certain requirements. So But these banks must subscribe to stock. That means they must purchase stock equal to 6% of their own capital and surplus. In New York, the Fed, the most powerful branch, the biggest stockholders are typically Citibank and J.P. Morgan Chase. And in the past, these two banks alone have held over 70% of the New York Fed's shares. So my question is, in all of this, is who actually is the real owners? And this is where it gets a little tricky. While these private banks own the stock, they don't have the same rights as someone owning shares in like Apple or Ford or something like that. It's a little bit different. I mean, if you own private stock, you can sell it, trade it, do all kinds of things. But the Federal Reserve, those shares of stock cannot be sold or traded. It cannot be used for collateral, for a loan. And of course, their dividend is capped at 6%, where if you buy stock, there's no limit. However high the stock goes up, that's how much you can make. If you own shares in a corporation, certain types of shares, then you have a vote proportional to the number of shares. But in the Federal Reserve, it's one bank, one vote kind of a thing. The Fed creates digital reserves to buy those U.S. Treasury bonds. This is like your checking account or the unlimited credit card thing. While the Fed doesn't decide to spend money, only Congress can do that. It does make it much easier for the government to borrow. When the government spends more than it has, the Treasury issues bonds or debt. If there aren't enough private buyers, the Fed steps in and buys the additional bonds they need to meet their needs. When the Fed buys these bonds, though, it doesn't use the saved money. It creates new digital reserves to pay for them. A couple of keystrokes on the keyboard, now you get all the money you need. Okay, so there's three main buyers groups that can buy these Treasury bonds. We have institutional and individual investors. This includes pension funds and insurance companies and regular people. You can go on treasurydirect.gov and you can buy Treasury bonds. But for the most part, it's the insurance companies, pension funds. And then we have the central banks of other nations like Japan and China. They buy these bonds as reserves. They usually buy them through the Federal Reserve Bank of New York, which acts as their agent. The glitch here is that this is the part that feels like a shell game to me. The Fed is technically prohibited from buying bonds directly from the Treasury. That would be a direct constitutional violation of printing money kind of a thing, right? That's supposed to be only done by the Treasury Department. Instead, the Fed waits for the primary dealers to buy the bonds first, and then the Fed buys the bonds from them using digital money. The government doesn't just print money, though. They hold an auction, right? This is how this works. But there are only certain people allowed to bid at the big table. And they're the same big banks that own the regional Feds. These banks buy the debt, and then the Fed buys it from them. It's a closed-loop system where the same few players are the wholesalers, the retailers, and the banks all at once. Hell of a business model, isn't it? Does monopoly come to mind? I don't know. I'm not sure how we get away with it, but I guess we got it worked out. Here's the problem I see. Since the math of paying it back is impossible if you look at it. The foxes, they're supposed to be guarding our hen house, have a workaround. They don't actually intend to pay that $39 trillion back in today's dollars. Instead, they use inflation. For example, if you owe somebody $100 today, and the government prints so much money that the $100 only buys a loaf of bread tomorrow, your debt has effectively been inflated away. You're paying back the debt with currency that is worth significantly less than what you originally borrowed, as far as buying power. And you thought inflation just happened. You didn't know that our government built it into the system so they could keep spending and wasting our money. I found you guys know I like history, right? I mean, if you'd listen to my podcast, you know that. I found a quote by Thomas Jefferson that I found very, very appropriate. He said, "I sincerely believe that banking establishments are more dangerous than standing armies, and that the principle of spending money to be paid by posterity under the name of funding is but swindling futurity on a large scale." Our founding fathers, were very smart men. We should have listened to them much more than we did, I think. Our history should be taught more completely in our schools or something. Okay, so there's kind of a merry-go-round thing going on here. The Treasury pays the interest to the Fed pays its bills, and then returns the remaining profit to the Treasury. Although currently that's on pause because the Feds have a $225 billion deferred asset loss. It's another way of saying they have a deficit. They've deficit spending. I wonder if that is part of the reason that Jerome Powell is fighting President Trump's request to lower interest rates. I mean, selling treasuries with a higher interest rate would seem to alleviate some of their deferred asset loss, maybe. We don't really know how much they make, right? Because they've never been audited as far as I know. Since the money is created as debt, but the interest for the debt is never created, the total debt must grow perpetually just to keep the system liquid. Right? It can never end. You can never pay it off the way it's set up. This is the glitch in the system that ensures that this debt just goes on forever. For instance, when the Fed creates $1,000 to buy a government bond, they expect that $1,000 back plus interest. Let's say maybe $50. But the Fed only created the original $1,000. That extra $50 for the interest was never created, so to find the money to pay the interest, the government or the public has to borrow more money into existence. This is why the national debt doesn't just grow, it must grow. If the total debt stops growing, the system runs out of money to pay the interest on the old debt, leading to a liquidity crunch or a total crash even. Does the term loan sharking come into mind there? I mean, that's kind of the way they do. They create this system, and the way the interest works, there's no way you can keep up. All you can do is barely pay the interest, and that's how they make their money. Okay, so there is estimated at $39 trillion in debt, right? But there's only approximately $2.5 trillion in actual physical currency in coin. The rest is all digital. We've created it out of a couple of keystrokes on a keyboard kind of a thing. Referred to as the ghost economy, if you will. Since the debt cannot be paid back with real value, the system relies on inflation to devalue the currency, making the debt cheaper, while eroding the public's savings. The math last year, if you will, the U.S. spent approximately $7 trillion, but took in about $5.4 trillion. I don't remember the exact number, but it doesn't really matter. So the fact is we spent about 23% more than what we had. In my way of looking at it, this is the real built-in inflation number, right? No matter what the government's official numbers are, that's what they've done to us. So if there's only $2.4 trillion in cash, where's the other $36.5 trillion? Well, the only other things that exist in these accounting interests, this digital money. They refer to some of this as the M2 money supply. So if you look at all the money and all the bank accounts and savings accounts and money markets, that equals about 22.6 trillion. So even if you took every digital dollar in every American's bank account, you still couldn't pay off the $39 trillion debt. There's literally not enough money in existence to cover the debt. It's called perpetual debt. I wonder if somebody designed it that way. What do you think? Pretty sick, right? Our system depends on the constant selling and purchasing of Treasury bonds to keep the system afloat. Problem is, other nations like the BRICS bloc are moving away from the dollar and treasuries in favor of gold because they see the overdraft becoming unsustainable here in the U.S., this built-in overdraft system. A nation down on its knees for loans, asking for loans, right? I mean, that's the way they see us. We over there to try and negotiate with them, but I mean, one of the first things we send somebody over there to get down on our knees and beg them to take our treasury paper so that we can keep everything afloat. When you owe a bank $1,000, the bank owns you. But when you owe the bank $39 trillion, you have a very strange kind of leverage. It's what I call mutually assured destruction. That's a term that came from the nuclear days back in the Cold War. If a country like China suddenly dumped their assets, their U.S. assets, it would crash the U.S. economy, or it could very well. But it would also destroy the value of billions of the other assets that they hold that are tied to the U.S. It's like being tethered to a sinking ship. They want to get off, but if they jump too fast, they'll drown in the wake. In the past, the U.S. could dictate terms to other nations because we controlled the global checking account, if you will. But now, as nations move towards their own payment systems, like the BRICS nations are doing, our threats carry a whole lot less weight. We can't tell a country, do what we say or we'll kick you out of the dollar system if they've already moved on to another system. Because other nations see us down on our knees begging them to buy their treasury notes, they are building a world that doesn't need us. We are seeing the rise of the de-dollarization. Nations are now trading oil in yuan and rupees instead of U.S. dollars. I mean, you have to understand for, 50 or 60 years or so, the dollar has been the international trade currency. Oil has been priced in dollars per barrel. Wheat's been priced in, so much per metric ton or whatever the unit is, but it's been priced in dollars. Countries had to have dollars in order to pay and make those trades. But that's starting to fall apart. This is the ultimate sign of loss of respect. They aren't just refusing to lend us money. They are building a whole new bank across the street where our overdraft protection doesn't mean anything. So I had the question, after I got going through this, my question became, how does our federal bank system work, compare with other countries? What are they doing? How does their banking system work? We are essentially the only major superpower that has no government ownership, right? Our government has no ownership in our central banking system. We control that board of governors, and they're the ones that kind of decide the interest rates and things, but the actual banks, we don't. So while most central banks are government-owned, they still try to act independent. I mean, meaning the president or the prime minister, he can't just call them up and say, hey, print me $1 billion for my re-election campaign. It doesn't work quite like that. The European Central Bank, this is kind of a unique system because they're a kind of a super bank owned by various nations of Europe. It is considered even more independent than our Fed because it doesn't answer to just one government, but 20 different ones. The Bank of Japan, on the other hand, is a little bit much more closer to our government. If the Japanese government wants a specific policy, the Bank of Japan usually falls in line much faster than our Fed does. So, let's take a look. Here's how the rest of the world tries to keep the foxes in line while they're supposedly watching the hen house. That's the way I look at this whole thing. It makes no sense. Okay, so in Germany, this is one of the most famous examples. After living through the nightmare of hyperinflation in the 1920s, where people needed wheelbarrows full of cash to buy bread, they developed a deep cultural fear of debt. In 2009, they wrote a debt brake directly into their constitution. It limits the government's structural deficit to 0.035% of GDP. It's right in their constitution. We should look into something like that. It's going to be hard at this point, but for many years, German actually ran a black zero, what they call a zero deficit. I mean, that means they didn't spend more than they took in. But, things are changing a little bit. But while the U.S., our debt to GP ratio is currently about 125%, Germany's is still around 63%. Critics say this makes them too stingy. That's the EU. Of course, they want them to spend more money, but leading to crumbling bridges and slower internet because they refuse to borrow money even for good investments. Sometimes you just have to work and make sure you can pay for what you need. That's what we have to do in our households, or if we want to survive, we do. Then we have the European Union. The European Union, any of the countries that use the euro, like France, Italy, and Spain, they are technically bound by their Stability and Growth Pact. That says that no country is supposed to have a yearly deficit larger than 3% of GDP, and their total debt should never exceed 60%. If a country breaks these rules, the European Commission can trigger an excessive deficit procedure, which can lead to massive fines. So for context, the U.S. deficit in 2023 was about 7.6%, more than double the limit allowed in Europe. We are essentially living in a state of permanent violation by their standards. Okay, because most other central banks, like the Bank of England, are 100% government-owned, they don't have the blurred lines of private shareholders like we do. In these countries, when the government borrows, it's a very transparent transaction between the Treasury and the state-owned bank. There isn't a 6% dividend going to private banks somewhere. However, this can be a double-edged sword. If the government owns the bank entirely, it's much easier for a politician to force the bank to print money to fund a deficit, which can lead to inflation. You just have to elect the right people to government, I guess. Okay, so now we have a group of countries which we refer to as sovereign wealth countries. That's like Norway and Saudi Arabia. And they do the exact opposite of all these other countries. Instead of an overdraft account, they have a savings account. When they have extra money, usually from oil or other natural resources, they put it into a sovereign wealth fund. Norway's fund is about $1.6 trillion right now. They don't borrow to pay for their government. The interest from the savings pays for a huge chunk of their public services, like public education and public health care, that kind of stuff. So, for my last comment here, in my podcast, if you listen to it, it's called Dig Baby Dig. I propose the idea that our government should consider not just owning all of our natural resources, but profiting from them, similar to the Saudis or in Norway. Wouldn't it be great to have a sovereign wealth fund rather than a $39 trillion debt? Well, I guess the downside would be that the big oil and big banks wouldn't be able to screw us to death. So there is that, right? Well, I'm going to leave that with you today. I hope you found it entertaining and educational or thought-provoking. Join me again next time, won't you? I'm Craig Warren, and this has been the Ramblings of an Old Fart Podcast. God bless and keep you till next time.